I'm not terribly concerned about that being a point of friction.
Hello, I'm John Janarone, Editor-in-Chief of IPO Edge. Very happy to be back here at Nasdaq MarketSite. I've got JD Moriarty, who is now leading ICR Capital. I happen to have known JD for many years back at his days at Merrill Lynch when we talked about the Open Table IPO in early '09 and many more things. So what a treat to have him back here. JD, thanks for joining us.
Thanks for having me. Appreciate it.
So JD, tell us about the new role and what you're excited about.
Well, it's interesting. I mean, over the last, I've been gone from the equity capital markets and investment banking world for about 7 years. And as I spent the last year thinking about what I wanted to do, I thought a lot about working with clients and doing so in an advisory capacity. And what has happened and really changed since I left is the role of the advisor has grown. And whether it's an IPO or a convertible offering, the advisors have proliferated. And so that's really interesting to me because that actually, it makes a lot of sense when you consider how opaque some of the processes are. Despite the good work that the banks do, to the average management team, the process is fairly opaque. And so that's what we're trying to do at ICR Capital and at ICR broadly. We want to bring an integrated approach to advisory. And the idea being most companies that are going public, focusing on IPOs, most companies that are going public are investing a lot of their time. And that time should be invested in a goal of not just a successful IPO, but being very well prepared to be a public company. And so that's the opportunity. I also think that I'm joining at a time when obviously it feels very much like the market is improving a great deal, and where the desire on the part of both sides of the market to see a robust IPO market and new issue market broadly is there. You certainly see it on the buy side. And we're seeing a lot of very good signs on the supply side.
JD, let's talk about private equity for a moment if we can. So at our annual conference we had a few weeks back in Palm Beach, we had some folks talking about this enormous amount of investment by private equity that has not been monetized. There's been no transactions. We're talking like, third quarter, fourth quarter stuff, 8-10 years in. Mm-hmm. How much of that are we going to see come through in terms of an IPO in the next year or two?
Yeah, so I think the encouraging thing is that the market is broadening. So I don't suspect that we will have a narrow IPO recovery, which is very good for private equity. You do not need to be a hyper-growth company. You do not need to be an AI story to go public in this market. So that's great for private equity. Now, private equity as an industry has gotten very creative with continuation vehicles to extend their investments in some of these companies, which, by the way, they like a lot. So over time, what's going to happen is their ability to hold on to some of these assets is going to improve and already is. But certainly a viable IPO market is very good for private equity. We've seen a lot of signs of portfolio companies getting ready, taking action. The tone of the conversation has changed. Some of that is how long they've been in portfolios. Some of it is also the business cycle, right? And recognize that some of the companies that we're talking about perhaps received a very aggressive valuation in the 2021 timeframe,
yeah.
And they're conscious of the monetization path, right? Again, they don't fully monetize at IPO. They've got to be conscious of the IPO, the initial add-on, and any subsequent monetizations. So it's really about a process, and I think most of them would think about that as the beginning of the process of call it 2 years of monetization for their stake.
Interesting. JD, something that I noticed with the broader financial media is if a deal prices and it pops too much, they say, money was left on the table.
Sure.
In my mind, my view is we all want this market to work, right? So do you think deals will be priced somewhat conservatively in the next couple quarters to avoid, okay, you leave some money on the table, but don't we want this system to succeed?
Yeah, listen, in response to that, we've seen some more creative adjustments to the process,
yeah.
Right? And there are a lot of advocates for direct listings that are in response to that issue. But not every company is going to face that challenge.
Yeah.
For many companies, it's really about just finding the right shareholders, and that's why we encourage people to start early and get those anchor shareholders. As it relates to, I think as it relates to the pricing environment in this, as we start 25, will there be some conservatism? Yeah, I think so, sure. People have waited. In many cases, their businesses have evolved. They've waited for their businesses to grow into the valuation that they achieved before, right? So you're reading a lot about companies that are simply trying to go public in and around the valuation that the private market accorded them in 2021. So I think there will be some conservatism there. That's an opportunity for public investors. And I think the more interesting challenge will be the size of some of these IPOs. And that's an opportunity for public investors as well, right? To really put money to work in some of the scale players.
Well, another thing that I think you alluded to a moment ago was, effectively a down round IPO. How frustrating is that for a management team, or also, their private equity or venture capital investors? I mean, are people, willing to, face the music and just do it because it's a reality? It
really just depends on the scale of that down round relative to the cap table, right? In some cases, right. So I think that certainly the aversion to that has diminished. We have been through these cycles before where some pretty successful public companies, now public companies, went through that process, went public at a value lower, and it was the right thing to do because they knew that their future was as a public company. They had to kind of put that in the rearview mirror. So I think we'll see some of that. I'm not terribly concerned about that being a point of friction.
So let's talk again about the buy side. What do we need to see for deals to work, for appetite for IPOs and so forth?
Yeah, so this is really just a risk curve issue.
Yeah.
Are investors moving out the risk curve to look at new stories? I like to say, when you have great volatility or great uncertainty, so think about the election, think about some of the global events, think about interest rates. Well, we've removed the election uncertainty. We've largely removed the interest rate uncertainty.
Yeah.
We still have the global uncertainty. But when you have those things there, you tend to focus on the things that you own, not the things that our industry, broadly speaking, wants to show you. You don't focus on new stories. We're seeing signs that investors are willing to look at new stories. Sometimes you have to look at actually not just the IPO market, but the add-on market. And when you look at follow-on financings for companies, and is the pricing tightening on those? Yes. Is the breadth of the buyer base improving, right? So more people using those opportunities to establish new positions? Yes. So here in the fourth quarter, when we look at the add-on market, that's a very good indicator for the IPO market. That means that investors are moving out on the risk curve, and we're hopeful that that continues into 25.
Interesting. I was looking this morning before we jumped on stage here. There have been some really good IPO stories. Sports, I think.
Yeah.
I mean, that's been a double. That's a very big positive, isn't it, to see a company like that? And that's not. I mean, it's a growth story, kind of, but it's a consumer brand.
I think the biggest takeaway from that transaction is the receptivity to the follow-on transaction. Right, that's a perfect example of what I'm talking about, where the breadth of demand that was generated in a relatively short period of time. By the way, in December, right, not everybody is simply adding to a position. There are people taking on new positions there to a stock that had run materially since the IPO. That's what I'm talking about. That's a very good sign. And to your point, not everything has to be hyper-growth, right? It's just a high-quality company that's getting a great reception in the market, much better than they did when they went public.
I talk with one of your now colleagues, Steve Parrish, a lot about this, and I always ask Steve, do you need to be profitable? And he says, well, you should be, but you don't have to. There are stories that will work without profits. Is that true?
Yeah, I think I'd go back to my point around uncertainty, right? At the end of the day, it is about the certainty that you can put into that path to profitability, right? The more that you can give somebody confidence in that path so that when they see indications that you are actually living up to your promises, you'll be fine. So it's really about that. Now, obviously, we go through points in the market, like we did in 21, where that's not in focus. Investors are way out on the risk curve.
Yeah.
We're not going back to that anytime soon, but it's really about that path to profitability.
All right, so JD, let's wrap it up with a little bit of a focus on your new role, if we can go back to that.
Sure.
You ran equity capital markets at a bulge bracket bank. You're going to lead ICR Capital. What are you going to do differently that's not being done by the other folks out there advising companies on the path to an IPO?
We are focused on, we often use this term, just an integrated approach. And what that means is you have an industry expert and a capital markets expert leading your transaction. The industry expert is an important piece of the equation because we want you to be prepared to be a public company, not simply execute an IPO. And I often said before, too many companies that I worked with over the years started the process by thinking that the IPO was the goal line, and it really is the starting line.
Yeah.
So we want people to invest in the total process, which means the preparation of being a public company. We think we're best positioned to do that. We also think over time there are opportunities to grow ICR Capital beyond just equity to other products as well, because there's clearly a need for advice as you think about the expanding private credit universe, for instance. Over time, we think there's an opportunity for us to help corporates there as well.
JD, I'm going to ask you kind of a tricky question. I was, there front and center during the big boom 2020, 2021. In my mind, a lot of those companies should not have gone public. Sure. Would you ever advise a client, just tap the brakes, wait a year or two because you're not ready? Would you do that?
Did it all the time. Did it all the time in my previous role, and one of the more gratifying things was when clients remembered that was good advice. And I had a client many years later after I had left Bank of America who I ran into at a conference, and they said, you gave me the right advice, which was that I wasn't going to hit the timeline. The timeline is really important. And so we often give that advice, and that's the opportunity as an advisor.
All right, we're going to leave it there, JD. This has been a real treat. All roads lead back here to Times Square, apparently. Started my career here, spoke to JD 15 years ago. What a pleasure to have him back here. I'm John Janarone, signing off here from Times Square. I'm the editor-in-chief of IPO Edge.